Ready to go on? Chapter 14. Chapter 14. Okay. We are going to spend several classes talking about business deduction. And what's key here is that anytime you open your wallet, open your pocketbook, and now, I have to say this, some of you, not all of you, use your smartphone to make payments. So it used to be, how much money or you pulled out your credit card, but now the world is changing, and there's all different ways to make payments. Let's just go 30,000 feet up, and then we'll drill down. So 30,000 feet up, let's talk about expenditures and what code sections can be in play with respect to expenditures. And I'm oversimplifying, but at least from 30,000 feet up, it makes sense to oversimplify. Okay? The nature of the expenses can fall into three different categories. So anyone want to throw out a category of what that expenditure can fall in? 30,000 feet up. Right here. Very good. Someone's shouting out a word. I think someone's whispering a word. Deduction, I think.
I was up there.
Deductible. Under what Larry? Is that you?
No, was not.
Over there?
162. Deduction.
Right here. Deduction. Under what code section?
162.
162, okay? So you make an expenditure to be deductible under code section 162, okay? If it meets the parameters, it can be deductible under code section 162, all right? Agreed? Agreed. That's one expenditure. Another kind of expense you can have? Deductible. You said deductible, so is there something else you're adding to here?
I guess itemized deduction.
I'm just going 30,000 feet up. You can have an expenditure which is non-deductible, right? Okay, you go into a supermarket, you buy food. Last I checked, is food deductible? Generally not. Why? Personal consumption and what code section controls? Code section 262. Go ahead.
What about meals and entertainment?
But generally, I say, by the way, groceries are not meals.
No, yeah.
All right, but we'll get there. We'll get there. So generally, personal consumption items, right, Dave, not deductible code section 262.
Right.
Personal consumption items. So we have 162, we have 262. We're missing one other kind of expenditure.
Partly deductible and partly
Well, Alicia says partly deductible, partly not. But no, what I'm really looking for is just in honor of him today. This is not a political statement. A Trump kind of expenditure, which is one that has to be what, Nick?
You're talking about appreciation.
Capitalized. Okay, you buy buildings. Okay, you capitalize those expenditures, right? It's actually 263, right? A capitalized expenditure. So section 263. So that's the starting point. Just another point on that, by the way, non-secular sort of about grades. Look, let me also make the observation, generally, even if you have a crazy work week, you're not prepared, that's life, I totally get it. It's always usually better to be here physically than just to get the notes. I do think it's worthwhile. I don't take attendance, but I do think, and you can see, a lot of the problems are parroted off things that we've spoken about or have repeated that you may not get to play with just from reading people's notes. So again, to make it to class, always better. And I do think, when I do try to keep the exam, don't look on the final exam that, hey, there's a trick question here, he's trying to get us. I have no thrill, no joy in getting people to give wrong answers, all right? To the contrary, you know, my Holly will make or break depending on how you guys do. So I will try to keep the exam questions truly straightforward. So if you're reading an exam question and saying, boy, there's a real trick here, you're probably not seeing what I'm trying to get at, okay? The exam questions are designed to be almost, again, repetitious to what we covered in class. Nothing tricky, as straightforward as possible, right? All right, so everyone got 30,000 feet up. Now we have these three different baskets because I think that's a good starting point to see this entire chapter. Yes, there will be other code sections that you will learn, but if you can get those down, you'll be able to frame things and see where they belong. All right, the first case we look at, you can add this, it's quite the night. You're being introduced to two major court cases that you can. I'm really going to have to help you out on your Saturday nights because now not only can you mention Lucas v. Earl, but Welch v. Halpern is of that ilk. Welch v. Halpern is of that caliber of famed Supreme Court cases. All right? So you should add this to your repertoire of cases that are well known in the tax world. And it's written by Justice Cardozo, which many learned scholars, constitutional scholars, when they named the top 5 Supreme Court justices who have ever served on the court, in many, not all, in many lists, will include Justice Cardozo as one of the top 5. Okay? Justice Holmes, Justice Cardozo. People have their favorites. I'm just telling you that he's known to be a very wise legal scholar of his time. All right. And there's a law school in New York City, Cardozo Law School. It's named after him. All right. So recall that Mr. Halpern is the then commissioner. Welch is the taxpayer. And I'm not entirely sure, many of you may have just have read chapter 12 without the expectation of us going into chapter 14. That's okay. Did anyone have a chance to read this case who would like to share their thoughts? Luca?
This is where he was the secretary, correct, of the company originally?
Okay, so what happens? You have a tax-
He got a new job and bought back the company.
Okay, so taxpayer originally worked for a company which, to the best of my recollection, Luca,
And
goes bankrupt.
Yes.
Okay? And James, feel free to jump in here, okay?
Didn't he get hired for another job and then to improve his credit?
Right, hold on, but and I think the word hire may be a misnomer. I think he started a new business. He wasn't hired. I think he started a new business enterprise. All right? So picture, if you will, company he worked for goes bankrupt, owing lots of people lots of money. He decides to start a new business venture. Right, James, right, Luca? And what does he do?
He buys back the business and then pays all the debt to get the
I
credit.
don't know if he buys, you're using the term buys back the business. I think he started a business enterprise. And, James?
Does he want to pay off the debt?
He pays off debts that he didn't have to, right? We don't need too many Mr. Welches, do we? People who are willing to pay off debts that they don't owe. Get the visual? Luca, you were going to say something?
So he just paid off the debt of the company, he didn't buy the company?
No, the company itself is bought back by a bankrupt company. All right, so everyone have the visual? Your prior employer goes bankrupt, and you're going to start a new business enterprise and pay off the debts of the old company, right? Now, before we think Mr. Welch is a saint and every time he goes through a door he has to lower his head a bit so his halo doesn't hit the top, James, Luca, what was his rationale for making
He wanted to deduct these payments.
Well, that's for tax purposes, but why did he make, tax wasn't driving him. What was driving him to make the actual payment?
To fix his credit.
remember, it's not his credit. His credit may be fine. It's before the day and age of, creditscore.com. But I'm assuming Mr. Wells had a stellar credit rating. So it's not his credit, James. Why is he doing this?
I thought it was credit, that was gonna be his reputation.
Say,
Reputation.
whose reputation?
Well,
Welch's, right? He's doing this to say to the business community, I know my prior employer screws you guys out of money, but I'm gonna run a different kind of ship here. In fact, I'm running such a good ship. I'm gonna establish goodwill, right? He's making these payments because you can trust Mr. Welch, right? I trust him, right? Everyone agree? Anyone who's willing to pay off a debt that truly doesn't owe is probably a person who's gonna be a person of his or her word, right? I'd like to do business with this guy, right? Jessica, you'd like to do business with this guy, right? All right, so everyone gets the framework. And the question then becomes, right? Are these payments, and they're pretty significant given the years involved, are they deductible, right? Because he's not doing this again as a charitable act. And by the way, call this cliche, it's fine, I mean, cliches sometimes work. Generally, not always, when you spend money to make more money, that should give you an aroma of something that's deductible. Everyone agree? When you spend money, and you're spending money not for personal consumption, you're spending money with the expectation of making more money, that should throw off an aroma of being deductible. Agreed? All right. Bearing that aroma in mind, what do you say in terms, Luca, James, what happens here? What does the renowned Justice Cardoza say? By the way, the tax court and the appeals court, the IRS prevails. And by the way, on page 338, 3 lines down, the commissioner ruled that these payments were not deductible from income as ordinary necessary expenses, but rather were the nature of capital expenditures, an outlay for the development of reputation and goodwill. So that's in a nutshell, that's the commissioner's position, that these are non-deductible capital expenditures under Code Section 263. And just, if you could, because this is so critical to what's going to happen in the next few classes, take a look at Code Section 162. If you could. A. There shall be allowed as a deduction all the ordinary and necessary expenses paid or incurred during the taxable year in carrying on any trade or business, including, and it's going to list 3. Now, this is akin to Code Section, remember Code Section 61, it said all accretions to wealth from whatever source include, but not limited to, and then it listed 14 or 15 different items. Everyone agree? It was very expansive. This is the same thing. It doesn't have, it has the word including. Maybe if I were Congress, I would have said, but not limited to. So this too is going to give you just 3 examples of deductible expenses, but certainly deductions are much, much broader as well. Okay? So you have to meet, and with this requirement of being ordinary and necessary. Everyone see that? What the authors are going to do, by the way, and what we're going to do as a class, is we're going to go through this beginning language here. What are ordinary and necessary expenses? We're going to learn. What is carrying on a trade or business? And then we're going to look at reasonable allowance for salaries. We're going to be looking at travel expenses, and we're going to be looking at rentals. Okay, so just like the statute is set forth, we, hand in hand with the authors, are gonna go through 162, the prefacing language, and then 162, A1, A2, and A3. Just to give you a little foreshadowing of what's to come. All right, so the IRS has made its argument, right? Luca, James, who prevails and why?
The IRS prevails, it's non-deductible.
Not deductible. And Luca, why?
It's not ordinary, necessary, is it?
James, you agree not ordinary necessary? Hold on, let's pause. Justice Cardozo says, hey, these expenses were necessary, right? At least in the taxpayer's mind. Look at the second full paragraph. We may assume these payments to the creditors of Welch Company were necessary to the development of petitioner's business, at least in the sense they were appropriate and helpful. Okay? Everyone can see that? So it did meet, but it has to be ordinary and necessary. It meant the necessary. Was this ordinary though? If you look at the top of page 339, what does it say? You should have to say that the payment in such circumstances, instead of being ordinary, is in a high degree extraordinary. Everyone see that? So it met 1/2 of the conditions here. It failed in the other half. Everyone see that? And therefore, on page 339, the first full paragraph, it says, the Commissioner of Internal Revenue resorted to the standard in assessing the petitioner's income, found that the payments in controversy came closer to capital outlays than to ordinary necessary expenses in business operation. And what Justice Cardozo does, if you take a look at footnote 1, he points out what are considered ordinary expenses. Okay, he gives some examples of what might be considered an ordinary expense. And in the second paragraph, points out those kind of expenses which would be deemed non-ordinary and have to be expensed. So I invite you or encourage you to take a look at footnote 1. I know many of you didn't think we'd get quite this far for tonight, but if you haven't looked at this case, it truly is a gem, and it does give you a better idea of a lot of how business expenses are looked at. You really should look at the entirety of the case, including footnote 1. Right? There's two questions that are spelled out after case on page 340. Does everyone have? Taxpayer is a businessman, local politician, is also an officer director of an SNL, which he's the founder. When partially due to his mismanagement, he has the man to go under. He voluntarily donated nearly $500,000 to help it out. Is the payment deductible under Code Section 162? Luke, you have your hand up.
Yeah, it would be deductible since he's trying to save an existing and continuing business as opposed to starting a new one.
All right.
As in Welch.
Look, Many of you, if you just read this question, it seems like the Welch v. Halpern case, I think for most people initially reading this question, your visceral reaction would be, hey, this expense should be capitalized. Because last you checked, right? Many people do not pay $500,000 to a company, right? Keep it afloat, right? Most companies, there's no personal liability, and if the company sank, it presumably would not be something that this person would be personally responsible for. Agreed? Agreed. Okay? So, in this particular instance, what is going on is that the distinction, if you guys were to Google or whenever you want, the Elmer W. Conti case, you can pull it up. What's the upshot of this case? The upshot is that it was health deductible because in contrast to the Welch v. Halpern case, which is the formation of a new business, this is an existing business that was sought to be sustained. So under that pretense, the court gave more latitude, more leeway, and it was held to be deductible. Okay? And I could have seen the case absolutely going the other way. So I don't think this was a slam dunk that the taxpayer won this. I think the court could have gone the other way. But again, key distinction, difference between a new business and existing business. Question 2. Employee incurred ordinary and necessary expenses on a business trip for which she was entitled to reimbursement and the filing of a voucher. So picture you go on a business trip, you spend $1,000, okay, you're an individual. Instead of submitting the voucher, she's not reimbursed, but instead deducted the cost in her tax return. Taxpayer able to deduct the 162 expense. Let me ask you, is this good tax planning? Forgetting about whether or not the taxpayer would be allowed this expense. Mike, what do you think? Good tax planning?
No.
No, why not?
Because I guess the marginal income would be,
Why
you
not?
end up getting less back opposed to just getting more back.
Why?
Because if you take the deduction off the top of your income, it's gonna not be this 100% benefit.
Okay. First of all, getting a deduction. Like if you spend $1,000 and your employer gives you back $1,000, you're made whole. Everyone agree? Economically. If you get a $1,000 deduction and your marginal tax rate is 40%, how much you saving? You're going to get back $400, right? Not a good. Well, you're still out $600. Everyone agree? It's not good tax planning, but it gets worse. Because this is what we call under Section 67, the miscellaneous itemized employee deduction. So it's only deductible to the extent it exceeds 2% of your adjusted gross income. All right, so you may even forfeit this deduction in its entirety unless your miscellaneous expenses, right, exceed 2% of AGI. So it's not good tax. Everyone agree? Poor tax planning. Having said that is poor tax planning, can you still deduct it? I mean, admittedly, it's not a good idea, but notwithstanding, can you deduct it? And the answer is no, okay? Because if you're entitled to reimbursement, this foretell, it's very akin to Welch v. Halpern. Extraordinary that you would not submit it for reimbursement. Right? Submitting it for reimbursement signifies legitimacy of the expense. Agreed? What kind of expenses you submit to your employer for reimbursement? Presumably legitimate expenses. What ones would you not submit to your employer? Say again, Javier? Personal. Personal. Like if you had, a few bottles of wine sent up to your room, right? Is that something you want to show your employer, have it on your bill, or do you say to the hotel, you know what, I'll pick those up, don't leave it on the bill? You're smart, you probably want to do that, right? So the chances are, if you're entitled to reimbursement and you don't, it really throws into question the legitimacy of the expense. Let me spend a few minutes just giving you an overview of what's to come, because I think that will be useful for the next few weeks. That I just give you some foreshadowing, and then we'll call it a night. The authors and the code have very detailed regulations about the difference between expenses versus capitalization under Code Section 263. So in chapter 14, we're going to learn all the differences, or at least some of the differences between expensing versus capitalization. Also bear in mind that beginning on page 351, there's a difference between expensing and capitalization for property that you can touch, tangible property, versus, at the beginning of page 351, intangible property. Very different approaches. So there's a discussion of expenses versus capitalization with respect to intangible. Notice on page 360, there's a beginning of discussion of carrying on. What does carrying on a trade or business mean? Why? That's the prefacing language in 162. What does carrying on a trade or business mean? Beginning on page 369, we're going to get into code sections 162, A1, A2, and A3.
162.
Page 369 begins the discussion of reasonable salaries. Page 383 begins, so page 369 is 162A1. Beginning on page 383 is travel away from home, which is code section 162A2. And you're not going to be surprised if the next part of the discussion is dealing with rental payments. And rental payments are going to be what? Going to be under 162A3, which begins on pages 403. Page 403. Okay. Then the author is going to talk about miscellaneous expenses, like expenses for your tuition payments here, what's deductible, what's not. We're going to talk, we mentioned before, about meals and entertainment, right? Some of those expenses, business meals and entertainment, deductible. And I want to point out something, that at the end, beginning on page 428 of chapter 14, there's an extensive discussion of depreciation. Now, in fairness to you, and hopefully good news for me, is we will spend a class or so talking about depreciation, and on the final exam, there will be several questions on depreciation. Everyone in this room should be able to do simple depreciation, period. There should be no excuses. So you must pay careful attention to the end of chapter 14, because there will be several questions to fuss about.
Is there any specific type of depreciation?
We will go through all the different types. Okay, we will go through 200% double declining, straight line, the alternate depreciation. Okay? Now, bear in mind that when we're done with this chapter, which deals with business expenses, what are the other kind of expenses, the other key kind of expense there is out there in the world? Personal expenses, 262. Well, what other kind of expense might you have?
Investment funds?
Investment expense. What code section? No, not 262. What code section deals with investment expenses, guys? 212. Okay, so chapter 15, guys, we're going to spend at least a class talking about code section 212 for investment expenses. So we have 162 dealing with business expenses. And under 162, we're going to see sometimes 162 is limited by code section 263, which requires capitalization. One other code section limits 162, peanut butter and jelly, 162. 274. 274 limits code section 162 expenses. And then, in addition, we have code section 212. Guess what? When it comes to 212 expenses, what limits code section 212 expenses? Code section 263, once again. The 263 does double duty. It limits code section 162 and limits code section 212 expenses. So is 263 an important code section? You betcha. And just to round things out, towards the last week or so for a class, you guys will be responsible not for the three-letter word who, but we will get into the issue of four-letter word. I'm careful here. Four-letter word. When. When. Okay. When. Okay. So there's a little foreshadowing of what's to come. I will see everyone on Monday.